You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means we are back once again. It's now quasi-monthly huddle time here on OPR, the portion of the show where we gather here together to answer all of your many and varied options questions. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever scintillating, at least we tend to think so, Options Insider Radio Network, upon which so many of you have just been binging these days. Keep it up. We love you all out there. Of course, if you're one of our many on-demand listeners, doesn't matter, whatever platform you get it on, Apple, Google, Spotify, Audible, YouTube, wherever you get it, including our mobile app. If you like what you hear, all we ask that you keep rating and reviewing. There are literally a legion of new traders discovering these markets almost every day, a day like today. Probably another good example. So if you like what you hear, keep rating and reviewing on your on-demand platform of choice. Of course, if you want to go above and beyond, you want to get access to exclusive content like great pro Q&A sessions. This is double pro week. So we have 2 pro Q&As coming at you this week, as well as, of course, Options Oddities every Friday, live access to this and every other show that we do throughout the week, and giveaways. We just gave away our pro trading crate earlier this week. Those are bespoke one-off items that we give away to our pro members every month. So that's all sorts of fun. You know where to go to learn more. theoptionsinsider.com/pro. Or if you're really cool, /secret club. Just don't tell anybody. It's a secret. And of course, keep those questions coming in. We literally couldn't do a show like this without those questions. And of course, he's champing at the bit. He's rearing to go. Joining me once again, the options guy himself, Mr. Brian Overby from Ally Invest. Mr. Overby, welcome back to your own program, sir.
Oh, it's awesome to be back, Mark. I love that we're trying to do these with a little bit more frequency. We get such great feedback every time we do a huddle up. So let's get together and let's huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, Mr. Overby, let us commence the answering of questions here. And we have a bunch to get to. Really quickly, I kind of want to pick your brain here as well, because we have a question of the week that is live right now. And I always love to get Brian's thoughts on our question of the week. We've had some interesting, very contentious ones of late. The one we have right now, Brian, we said the Fed, Ukraine, inflation, all conspiring to keep options volume relatively high so far this year. But the options market put up nearly 10 billion contracts last year. That was a record. Is it possible? Can we possibly beat that total in 2022, or is that just too much volume We gave you two choices this week. Yes, going to hit more than 10 billion this year, or no, we won't make 10 billion. Mr. Overby, you're a guy who lives day to day in the options flow, sir. What do you say for this year in terms of options volume?
Yeah, I would take the under. I see that. I can see the responses here that I'm in the negative relative to what the listeners are saying, but I just think that 2021 was an anomaly as far as option trading was concerned. People getting used to being at home and paying a lot more attention to the marketplace and to their finances. And I just can't quite see that we're going to get there in 2022, especially because of the downturn. People get scared, and a lot of times they run and hide whenever that happens. But so I would take the under on that line in the sand if I were to answer that question.
Look at you fading another record year, sir. How dare you? Now, I was on that camp for a while. I kept fading it. Yeah, I kept fading 2020 and 2021. I had my cynicism beat out of me, sir. So now I'm like, whatever happens, I'm down for it here. So yes, our audience are right. Almost 2/3, 61.5% saying yes. So they're very much in the optimistic camp as well. 38.5% saying no. By the way, we do have the numbers. We haven't had a chance. Of course, they came in right after our Option Block show on Monday, listeners. We haven't had a chance to parse them yet on the network. But so far, the year's off to a decent start. We have the numbers now from OCC for April. April, the busiest April ever, 9.4% increase from already insane 2021 level. Overall volume was lighter, 782 million. Remember, we've been flirting with 930, 940, threatening maybe even the 1 billion level a month. Didn't quite get there in April. But of course, April also a weird month. We had holidays. So you have to always look at how many trading days are in there as well. That's usually a concern when you get to April. But still, Brian, at least so far, March was the second busiest month in history, I believe. And April, at least, the highest April on record. So does that give you any cause for optimism, sir?
Well, optimism, I have a lot of optimism. Just, I'm a glass the glass is half full type guy. But when it comes to the total volume, we've had a volatile month, and I would expect to have some decent volatility. But usually what we've seen in the brokerage industry is that you get that spike up and you get that heavy trading, and then people have a tendency to look the other way after the big volatile months. So going into a rally, I think that we'd see some waning of the option trading as long as if we get a little bit more chop in the marketplace on our way back up. So, glass is half full. We'll say that. So we're leaning in the right direction.
All right, let's get out to some questions. We got some timely ones coming at us here, Brian. First off, of course, we are recording this on Fed Day, listeners. So the markets are liking what they're seeing. Obviously, we're recording this after the markets are closed. Most of the major indices, all the major indices up strong today. NASDAQ up over 3.2%. S&P just a tick under 3%. Dow about 2.8%. So explosive upside day. I say that because we have, looks like Check. Hope I'm pronouncing that correctly. Check says, is Brian buying this rally, or is this the mother of all dead cat bounces, Brian? Are you fading this? Are you on board with the hope train after the Fed? What are you thinking?
Well, I can't say specifically because just because of limitations of how I can address things being with Ally Invest. We did this week, if you listen next week, just get a little preface to what we talked about in one of the shows on Options, the Options Playbook Radio podcast, is we did a FOMO trade. And I think that that's the way that I would approach it, is trepidatiously. As I see the marketplace where we're at, I just like to dip my toe in the water. I don't want to necessarily miss out. So how did we do that? And the Options Playbook Radio, which isn't posted yet, but so you know what we're going to be chatting about. We just bought some out of the money cues. And based off of this rally today, let's put a little bit of capital back in the marketplace. Hopefully the rally continues. And this is one way where you can participate without all the risk in the marketplace. So always with option contracts, you can be as risky or as safe as you'd like to do it. One of the things that I would have liked to see is just a little bit more of a downturn. I would have been a lot stronger buyer of the market down around 4,000 in the SPX, only because we would have actually hit that 20% off the high level, which in right around that 4,000 level, we got a nice round number. Would have looked for maybe a little bit more of a bounce. We did see the VIX run up towards the 35, 36 level. We didn't get quite to the 40. I would have loved to have seen that too. So if we would have had a little bit more of a downturn, I would have been the sentiment would have been a little bit more bearish, and I would have been more apt to let's just jump on in and take the rally. But when the rally starts, the rally starts. So how do I always approach it? I'm just dipping my toe in the water. We talked about buying the out of the money QQQ. But we'll talk about other different strategies on how to slowly get back into the marketplace if you think that the downturn is over. And more importantly, what do you think is going to happen with inflation going into the summer?
All right, Brian, you want me to scare you now? We're talking about dead cat bounces. You ready for a scary number?
All right.
I happened to see this. This is old. We did this on OPR over 2 years ago now, back in March of 2020. This is one of our questions of the week from that insane month, March of 2020. You may recall it, Brian, a little bit of an interesting month. We asked them back on March 24th of 2020, just for everyone who keeps writing in, how low can we go? How much can we sell off? We asked you on the week of March 24th of 2020. The S&P is back in rally mode as everyone catches stimulus fever. Remember, we had just sold off aggressively. We were kind of right at the bottom of that V when we started to bounce. Fed was diving in with their stimulus. We said, hey, the market is surging over 8% and racing past, get this, 2,400.
Wow.
Do you think this rally has legs, or is it the world's biggest dead cat bounce? Where will the S&P close at the end of the week? We gave you 3 choices back then. This is real, over 2,400. A dead cat bounce, so below 2,400, or who cares, I'm in cash. Brian, 73% were fading the 2,400 level. So this is a dead cat bounce. Only 17% said it was going to be over 2,400 by the end of the week. Think about that. We didn't even break 4,000 in this sell-off, Brian. 2,400. Yeah. This wasn't like the primordial ooze of finance. You and I were doing the show. This was a couple of years ago.
Right.
So
that's just scary numbers overall. And the way the market came back was scary. I mean, in a good way, but it was crazy how the market just went straight up after the big downturn. And that's why I like to think about out of the money option contracts at this point in time. If you've gotten into cash on some of your underlyings, say you sold all of, I don't know, Google, because Google's been beaten up. You sold some of that Amazon. You sold some of your other tech stocks. Well, maybe you start by buying an out of the money option contract to dip your toe in the water. And then when you feel like the market is actually starting to rally back, because it's really hard to pick the bottom exactly. And this actually shows it by this old listener question that we had. So that's how you can use options to try to slowly get yourself back into a marketplace like this. And hence the reason why we had that as a topic on our podcast.
Yes, everyone was writing into me and telling me, 4,000 is a support. And below that, we'll definitely bounce off 3,700. 73% of you were fading 2,400 2 years ago. So, wow, that's scary. All right, Brian, let's go out to the live. The live folks want to get at you. Let's go to Age of Delaquarius. He says, does Brian still see a lot of upside call skew with meme stocks, or is that a pandemic relic which still belongs in a museum? Brian, we were just talking about this on our panel we did a couple of weeks ago. In fact, listeners, you guys can get access to that panel now if you want. This went live on our network earlier today. A little exclusive. I recorded that for you behind the scenes. I wanted our listeners to be able to play along too. Brian's been on that panel with me in the past couple of years ago. But Brian, one of the topics we talked about was this exact thing. The call skew we saw, the explosive upside call skew. Are you still seeing that out there? Or as he puts this, is this a pandemic relic which belongs in a museum?
Well, I guess I'll pass it back to you, Mark. I haven't looked at it. And if you guys have already, I'm pulling up the quotes as we speak right now, but the meme stocks have just been out of my head. Let's just put it that way, because of the downturn and everything that has happened. Now, I'm not saying that they've done horribly. GameStop is still, today it was up 5% as I look at it. But that was a big, and I think you can, obviously you listen to Options Playbook Radio, because I did mention that that even though everybody wants to think that the rally was over in the GameStop, meme stocks in general, I was just basically saying that the marketplace did not believe that just by looking at the skew in the option prices. So yeah, if I go out further in time, it's a little tough because I do see by just looking at the vol on the put side on the out of the money option contracts for the call and for the put, it's obviously very, very heavily shorted because you're seeing a lot more volatility on the put options than the call options. But the skew is still there. I guess I look at it as I go further and further out of the money. We got real option contracts, and the vol just keeps getting higher and higher. So the marketplace might not think it's over.
Let me put it another way for you, Brian. Maybe that's even more straightforward for you over there at Ally. You're watching the volume every day. Are you still seeing the Ally customers flock in day after day to do nothing but buy upside calls like they were last year, or have they started to mix it up a little bit?
Mix it up a little bit. Yeah, without a doubt. The last time that I looked, which wasn't as of this today, I guess it was a couple of weeks ago, we talked a little bit about it. Definitely the volumes overall were leaning on the sell side. The positions were waning a little bit, but the marketplace is still doing strong. So our clients were getting out of a lot of those stocks.
Yeah, so there you go, Age, everyone else who's asking this kind of thing. We have definitely seen a mitigation of the overall massive call skew that we saw last year. Doesn't mean it still doesn't exist in certain names. We still get the apes writing into us every now and then. Hey, I'm loving AMC or whatever the name, whatever's popping that day could certainly exhibit a lot of shorter term call skew, but it isn't as pronounced. We're not seeing, for example, like, the AMC 145s trading $1.50 like they were last year for size. That kind of stuff seems to have, as you put it so colorfully, maybe a bit of a pandemic relic, which belongs in a museum. But hey, the things start lighting up to the downside, you might see, maybe, who knows, maybe we'll see crazy put skew again. Maybe it's the flipping of that script. We shall see. 2,400. Not too long. I don't want to scare anybody. I'm just putting it out there as a data point. Read into that what you will. All right, Brian, let's go out to Meats. Oh, Meats with a Z. Haven't seen you in the list for a while. Welcome back there, sir. Good to see your questions coming back in. Making me hungry, Meats with a Z. He says, what is Brian looking at in terms of hedging strategies right now in SPY? Are you put spreads, stock substitution? Are you straight into cash? Brian, he seems to think you're getting the heck out of Dodge. You're not buying this rally, sir. So if you were looking to hedge right now in SPY, what would be your go-to, you think?
More, I'd lean towards the stock substitution because if you haven't gotten out already by this point in time, well, then you've already taken the brunt of it. So if I were in cash, implying that I did get scared out of the marketplace because of what's going on in Ukraine and where the 10-year is pushing up against that 3% yield level. If I were nervous, I'd be looking at a stock substitution. We actually, once again, just to go right back to the other question, on the QQQs, looking at buying some out of the money options just as a FOMO trade, fear of missing out. So I would say I would take some of my cash and I would look at a stock substitution if I were to think about buying the SPYs at this point in time, implying that I did go to some cash and I had some available to do it. That's where I'd be at.
All right. Speaking of stock substitution, that goes right into our next question here from the colorfully named Joe. Joe wants to know, hello, Brian. My question, is this a good time to be considering the fig leaf strategy, or is volatility just too high to be purchasing longer-term calls right now? Brian, you're just talking about the old stock substitution, a.k.a. the fig leaf. What do you have to say for Joe wants to know, is this a good time for it, sir?
Well, if I was doing I don't like the volatility actually in the marketplace. So I don't mind buying the stock substitution that we just mentioned. I don't mind looking at that. And as a matter of fact, this week on Stock Play of the Day, which we do on the Ally Invest YouTube channel, I talked about buying a deep in the money option contract on Chevron. And that was a little bit to do with what we heard from Warren Buffett over the weekend. Now, I got to emphasize when we talk about these things, though, these are just, they're not meant to be recommendations. That's not what we're trying to do here. We're just trying to learn on the podcast. So when we address that, we're just looking at it as, once again, a FOMO trade because everybody's nervous. How can we use options to manage that risk? What I would be looking at doing is buying deeper in the money options on some of the stocks maybe that I sold that I panicked and I got out on. And I wouldn't be selling a call against them because I do think, first of all, I just think that volatility has, especially like on a day like today, to see the VIX around 25% implied volatility, there's just not as much juice in these option contracts as there was. And I'm more worried about a rally taking out my short option contract before I even was able to get some of the money back, if you will, if you're thinking that you were in this market the whole time. So I like the stock substitution better than the fig leaf strategy. Doesn't mean that at a later date you couldn't sell a call against it. I don't know exactly where later is. We're just talking about generalities right now.
All right, we're listeners taking us all over the place. I love the journeys you take us on, from fading to dead cat bounces to fig leaves to hedging. Now we go to Aaron, wants to talk about flies. Aaron wants to know, can you explain how to use butterflies appropriately? Well, how long you got, Brian? You got a couple hours to, we could condense it all into 5 or 10 minutes. There we go. He wants to know, can you explain how to use butterflies appropriately? Should I be waiting until it comes right down to expiration or closing out earlier? And what kind of profit target do you see professional traders using? Finally, I fear I'm setting my wings too shallow. Is there any rule of thumb around how wide to set the width of the butterfly's wings? Take SPY, for example. Is $5 wide on either side too slim? Thank you very much. So a lot to unpack here, Brian. A lot of newcomers, they usually are a little bit intimidated by butterflies because there's a lot of moving parts, and you need to kind of have it sometimes hit that sweet spot to make that trade really make sense. Otherwise, you have to do a lot of adjustments. I know you love yourself a good fly, Brian. So what do you have to say here for Aaron? He wants to know, very, very easily, explain how to use butterflies appropriately, sir.
Well, yeah, and that is a whole seminar in itself. But I think Aaron has already answered the question by saying, is 5 points wide enough on either side or it's too slim? I'm assuming that Aaron probably had a 5-point wide butterfly on, came up and hit the short strike and noticed he didn't really make very much, or he or she, whoever Aaron may be. But with that said, 5-point wide is just really isn't wide enough, but it would have been extremely cheap to put on. And if you do it only 5 points wide, that means that you got a 10-point range that it could land in. You really need to be short term. If I'm going less wide on my butterfly, I need time decay to work for me even more if I'm correct. So in the SPY, right now we see that the SPY is trading at 428. It moved 2.8% today. That was 11 points. So I want to go at least what a normal move. I want to be at least 4% wide. So I'm looking at least 20 points in the SPY. In Amazon, when we just recently did one, we did one 40 points wide. We did 20 points wide, which gives you a 40-point landing area. The wider you go, the better you're going to be if you're correct on your forecast. In other words, it doesn't take quite as long to get paid on the butterfly by being wider on it. Means you pay a little bit more up front. But if you're doing directional butterflies, I would have a tendency to go to err to the side of being a little bit wider, spending a little bit more, taking on a little bit more risk, just because of the dynamics of that option pricing. If you're correct on your forecast, you need your short options to lose some time value in order for you to be paid, because the best butterfly means that you have to close out too short for every 1 by 2 by 1. You have to close out too short at the money option contracts. So if you're doing longer term butterflies, you have to lower your expectations as to what you may make if you're correct on your forecast in the short term. So Amazon, which we did last Options Playbook Radio, that would have been on April 27th is when we taped the show, right before Amazon earnings, which was on the close on the 28th. And we did a 1-day butterfly, just that simple. And it's a real interesting dynamic with Amazon. We always talk about butterflies because Amazon always announces earnings after, well, I shouldn't say always, I mean 99% of the time, they announce earnings on a Thursday. That means you have very expensive options that have 1 day to live. And if you can get it to land within that area, you're going to do pretty good on a butterfly. So that's the main reason why we do it is expensive stock, expensive situation, earnings, as far as implied volatility is concerned. And then also the options only have 1 day to live.
Yeah, well said, sir. You hit the nail right on the head. Who was this? Aaron. Yeah, Aaron, if you're doing 5-point wide flies, I mean, flies are challenging enough. Like I said, a lot of moving parts, like Brian just laid out. You have to balance the time decay, how far out you want to go, how much you want to pay for these things. I get why you're doing the tight flies. They're cheap. I get it. It's cool. You don't have to pay a lot. But you also, I mean, $5 wide fly, you need to really hit that bullseye and spy to make. That's hard. So you're not making your life any easier. I get your outlays lower, so that's attractive. But you also, I want to pay a little more for a fly that has a little bit more room to actually make you some money on these things. And also, yeah, there's a lot we can do. We've talked about flies many times. Brian has talked about flies many times. I encourage you, Aaron and everybody else, go back into the archives. But maybe we could do future additional episodes because there are so many moving parts. And we have seen a resurgence in questions about flies lately, Brian. So maybe it is time for another deep dive into butterflies, Brian. All the new folks coming in. You know, they don't know these fly things, Brian. What are these fly things we're talking about?
I agree.
Anything with wings is scary to them. All right, let's go out to this one. Speaking of scary, Tesla can be scary sometimes. This one comes, or I should say Twitter. Twitter also can be scary sometimes. Let's go out to this one. This comes from This came in actually to this show, even though we discussed it briefly yesterday, I think on OBC, because Dan liked this one. But he hijacked your question, Brian. But this came in for you. He wants to know, or maybe she, I don't know. They say, I own a call spread in Twitter, the July 50 double. So the July 50-55. Musk is buying Twitter for $54.20. That's, of course, the big deal everyone was talking about not too long ago and still are, listeners. He wants to know, does this mean that my option gets exercised on the long leg of 50 and the $55 short leg will expire worthless? Or should I cash out now with the underlying trading below 50 with a very small profit, or wait until Musk's offer goes through? What risks do I have here? Thanks, guys. Well, let's pull up Twitter. Obviously, a rising tide lifts all boats. Let's see how much Twitter got lifted today. Oh, a whopping 21 cents. So not a huge run. You're still below $50 there. And 49.06 is where it closed today. So, Brian, it's an interesting question. When this came in, I went and looked at OCC, because that's, of course, the first place I send everyone with these types of M&A and corporate event questions. Go to Options Clearing Corp. They determine all this stuff. And then type in your ticker and see if there's a circular with this exact information on it. If the settlement price has been determined, they will have it there for you. They will tell you exactly when and what price it will settle out at. And as of right now, I don't see that this deal hasn't been approved by the board. Said yes, but the Twitter shareholders have to approve this. So we're still waiting. And so far, the date just says sometime in 2022. So there is no settlement price. Brian, what are your thoughts on this? The notion that he has this spread that has a couple of months left in it. He has till July, so he can sit and wait on it. He does have a little bit of a profit on it now, he says. So that's probably going to go away if he waits. And then, of course, his luck, the deal will be announced on like August 1st, right? And he's out of luck on this trade. So what are your thoughts on this type of situation? What would you counsel him to do? Get the heck out of Dodge, or maybe wait, but then risk that little profit going away?
Well, the 55s. So I know a little bit about the Twitter scenario, because actually on once again, the stock play of the day on the Ally YouTube channel, I actually talked about a Christmas tree butterfly in Twitter the week of their earnings. And then part of the reason why is that the stock was more than likely just not going to do anything, because you had pumped up implied volatility, but there was a set price at which the stock probably wouldn't go higher unless the deal got canceled or some oddball came in and said they wanted to do it at 64.20 as opposed to 54.20. So because of that, we used some of that pumped up implied volatility and did a Christmas tree butterfly centered right around 50. And the stock stayed there. So the butterfly on paper would have worked out. And I'm going to take that information and I'm going to say, all right, if I'm long the 50 and I'm short the 55, that 55 is probably trading for next to nothing. I would think about just closing out the 55 and not having that concern, getting that off the table. Now, if you're a little nervous about everything, well, why not get out? Why not just move on, get away from the trade. But I would consider, because you're probably paying pennies for that 55 strike, because all of the volatility has probably been sucked out of it, assuming now that Elon Musk has sold so much stock, he's sold so much Tesla stock, that he may get the financing and the deal may go through. So with all that said, that if you ride it all the way to that expiration, you are correct. In your account, if you choose to do nothing, you would be exercised. You would buy 100 shares if you had one option contract of whatever Twitter was at that point in time. And then you would, and then nothing would happen on the other side of it. You would just be long the shares. So just keep that in mind, that is the scenario that would happen. And I would personally just trade out of it before I got to the expiration date and just take that whole thing right out of the picture. But obviously, it's up to you. I'm just talking about the dynamics of the options world. I more than likely would just close out the short side of the trade right now and just deal with the long option contract. If you want to speculate that the trade will go through, you remain long it. But if not, just sell it all.
I'm looking here, Brian, while you were talking. The 50s are trading for around $1.80, $1.60 at $1.80. So they're still pricing in a hefty premium that this deal is going to go through around that price. And then the doubles are trading for around $0.25 still. So there's still a fair amount of juice in this thing. So yeah, I can see why he says he has a bit of a profit. Looking a little better today, obviously, than it was a couple of days ago out there. So yeah, let us know what you intend to do there, or I like that handle. By the way, I think Brian's on something interesting. There's still a quarter, so they're not nothing, these calls, but you can buy them back. And there are things you can do around this. $1.60 at $1.80. That's still pretty hefty for these 50s. So it looks like they are still pricing in that by your expiration, there's a decent chance that we're going to be somewhere north of the 50 handle. Maybe, dare I say it, 54.20. I'll have to go look and see if there is a vote scheduled and what the date is for that. That will certainly give us a little bit more insight into all this Twitter fun. Speaking of fun, Brian, unfortunately, all good things have to come to the end, but we'll wrap it up. We'll give them one more to satiate them until the next time you and I can huddle up together. Let's go out here to JLS. He's got a fun out of left field question. He wants to know, has Brian traded a nano option yet? And what does he think of the concept of zero leverage options? Brian, these nanos, obviously, these are the effectively one multiplier options on the SPX from SIBO. They launched back in March to, I think you could say, middling fanfare at the very least. And they haven't done a ton of paper. They're somewhere around 1,000, 1,500 contracts a day these days. JLS wants to know if you've traded them yet, and then what do you think of a one multiplier contract, sir?
No, I have not traded them. I just don't know how they can come up with volume. And that's what it's really all about. How tight are the bid-ask spreads going to be? I mean, they couldn't even make the minis work, and it had a lot to do with the markets in the mini option contracts back in the day. I'm not quite sure. Then we tried binaries. If you remember binaries, Mark, those didn't.
You guys at Trade King were big on the binaries back in the day.
Yeah. Yes. Yeah, we were. To me, those made a little bit more sense than the nanos. So I haven't traded them. I have not really even looked at them that often. I just know that they're out there. And if there is some volume in it, please send me an email, and then I will, I'll take the time to go and look at the change for the nanos.
Yeah, that's one of the problems. You can't even pull them up with SPX, Brian. You have to go to special nanos. It's a huge pain in the butt. So that's probably not helping. Symbology is a big factor in volume. People forget that at the end of the day. If it's hard to find these things, people aren't going to trade them. And I made that same mistake at first. I went to SPX. I thought it was going to be a non-standard expiration or non-standard contract of SPX. And lo and behold, it wasn't there. I had to go find it under the Nanos ticker. So yeah, even I had a hard time finding them at first. So a short answer to your question there, who was that JLS, is no, haven't traded them. I haven't traded them either. And still waiting for them to catch fire, if you will. But Brian, the folks sound like they're having a good time here with the questions. If they want to hit you up directly in between episodes of this show, where should they go? What should they do, Brian?
Well, they can always email me at theoptionsguy@invest.ally.com. But ideally, I tweet about all the events that we do here at Ally Invest. You can just follow me on Twitter. Handle is @BrianOverby. And as always, I hope that any option contracts that you buy finish in the money, and all the ones you sell finish out. Thanks for coming, everyone.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.